Are we kind of ripe for carry trades? What could be the biggest risks here?
I think it would, I mean, you look at two legs, and obviously the big legs are the dollar. And, everyone's talking about rates, one more dovish hike out of the Fed in May. And, that sort of narrative speaks to the only other risk then is, the other currency, the local country that you're in. So, we've seen in the LATAM space, the Brazilian real, Colombian peso, they've put on some good runs, and they're at or near the, getting back into the top half of their 12-month range. And, closer to, talking about the only exception in Asia space would be Korea's one, where the narrative is a little bit different, and you can see that conjecture. There's a series of highs there in dollar Korean, and that could, once that is breached, we could go for a bit of a run. There is actually a golden cross forming in that chart, and that when that happens, when the 50-day average goes above the 200, we could really put on some runs. Otherwise, you've got currencies like Indonesian rupiah have been great carry trades for the first quarter, and as long as the narrative stays the same out of the Fed, they can go along debating it, but as long as they don't turn hawkish again, I think the carry trade largely remains intact. With the, obviously, like I said, the exception is if something political or maybe a little bit of banking crisis rears its head again, where the dollar might come back into favour for different reasons other than interest rate differentials.
Yeah, Michael, to that point you just made there, I mean, a carry trade, I guess, in many ways thrives when vol is low. But if that were to pick up, and where do haven flows go? Do we talk about the dollar yet again, now that perhaps also rates have maybe close to peaking, if not already peaked there, as far as, I guess, Treasury yields are concerned, to be more specific?
Yeah, good question. It's a curious thing, because in this instance, in this cycle, say this quarter, but let's talk about mild recession, all that, in the second half of the year, if something, were to hit the fan, and there was a flight to safety, I dare say that people would choose the yen over anything else, and skip the dollar, for that, as I said, that backdrop of the Fed, who's trying to work out its own ducks in order, and if that's basically sideline the dollar, then you'll see especially from within Japan, you'll see the yen put on quite a few runs. There's been a few papers, we put a couple out today from banks that they can see from current levels, they can see dollar yen down to 120 in that sort of circumstance, which I think that Ueda was maybe privately hoping that the Fed might do a bit of heavy lifting and try and get that dollar yen up a little bit higher, above 140, maybe 145, if they could maintain that hawkishness. But I think that ship has sailed. So, when he starts preparing the market for this review that he mentioned, June and beyond, that would see dollar yen, lose 15 big figures in pretty quick time. So whether it loses those 15 from, say, 130, that puts you down to 115 quite easily. It's a bit of a people are sort of like aching to get onto that trade.
Yeah, that's quite a bit of a distance, though. What has traveled quite a lot to the downside is the franc. I mean, we're coming off, 11% off highs right now. Does that also speak to that same narrative?
I think it does. I think that, within Europe's got its own issues, and, Madrid's got past the Credit Suisse debacle and all that sort of thing, and there's probably a little bit of a hangover that I don't think the market's fully confident that we're past that moment. So there's probably still some residual positioning around that. But in terms of divergence, like the ECB is nudged. I think Euro nudged 110 last night, and the big level beyond that is 110.33. And what that does to the franc, I think. If nothing else, changes there, it'll just be a euro move, and you'll see the franc gain with the euro as a consequence.